Oh man, so another green day for Bitcoin. Bitcoin opening its candle up green for the third day in a row despite a backdrop of horrible macroeconomic news. What is going on? Can this upswing continue? And more importantly, has the bottom, has that capitulation finally come to play and pass? We're going to look at the on-chain metrics. This is going to be a deep dive, guys. So if you don't have the stomach for some of these complicated on-chain metrics, it's probably not the video for you, but stay with you. I'm going to make it nice and easy for you guys so we can take away the data that we need. As you can see, Bitcoin, that third day in a row green, now got the break above its daily EMA ribbon, officially closing above, now flipping the daily EMA ribbon bullish. Remember, we failed to do that here and we watched that come back to the downside. Fortunately, it created that higher low and it continued now up. The next candle, which is today's candle, has also opened up green. So from a textbook perspective, this is looking good. The one doubt I still have right now is the struggle to break this 24,000 level cleanly, but we've literally just crossed the 24,000 as I'm recording this video. Can this daily candle close above 24,000? That's going to be the next key level. Remember, very quickly from a technical perspective, I shared my full view yesterday. Make sure you go watch a video of why I'm all in on this market right now. But what I'm looking at from a technical perspective is I respect that the bears continue to still be in control, right? I respect that the macroeconomy is really bad. I understand still that maybe we could revisit back down to 20K again after a run up. But I'm looking at this relief rally and all the technical indicators have suggested we are due this relief. And I'm posting this relief at anywhere up to 29, up to 32 range here. So I'm more than happy to take this long up to hit a short-term perspective. And definitely from my long-term portfolio, if I was not in the market, I would be extremely uncomfortable right now. Go watch this video so I can explain why, for those who are still procrastinating and making some excuses of why we may hit lower, therefore I'm going to come into the market there, right? I would not be betting on that. Even though I'm going to show the on-chain metrics, maybe we can come back down again, it's not worth the risk because all the signs have ticked off that capitulation has happened. And as I shared in yesterday's video, from a macroeconomic perspective, the markets have said, hang on a second, maybe the worst has gone now. Maybe that 75 basis point hike was the last big hike. Maybe that negative GDP reading was the last one. And you know, markets, they like to think ahead. And so if they think inflation is going to come down, if they think the next meeting is going to be 50 basis points rate hike, if they think the next quarter is going to be a positive quarter in GDP, then they're going to start their rally right now. Okay, so that's what we're going to look at now, guys. Make sure you hit on the like button. Don't forget to subscribe. As always, check out BYBIT and BitGet. Links in the description if you want to buy or trade any of these cryptos. I'm also using OKX very heavily recently because of their new dollar cost average pie feature, which I really, really like, guys. And again, they're not paying me to say that, but it's just a feature I was looking at for a very long time, which is why I'm comfortable showing it to you, because I was literally looking for this. All these different platforms, BYBIT and BitGet, were really good for trading, but I was looking for a killer feature that's really good for us long-term investors, right? Because as you guys know, the majority of my portfolio is long-term. So for those long-term guys, how do we... And by the way, you should all be long-term and short-term at the same time. But for the long-term part of your portfolio, how do we make sure we can invest in these pies, right? So I can just set it at, layer 1 pie. I can have a GameFi pie. I can have a Metaverse pie. I can have a DeFi pie and just let it auto DCA every week. So I'll be showing you much more about that in future videos. Now, let's get started, guys. The first chart I wanted to show you was this one, and this is entity adjusted URPD. Now, in essence, I'm not here to complicate this stuff for you guys. I want to explain this to the lay person. And what we're seeing here is the 20K region has attracted a large cluster of short-term holders, okay? So these are the red are your short-term, the blue are your long-term. You can ignore the gray, they're your exchanges. But in essence, what I wanted to show you here was the short-term holders are buying heavily, okay? There's large volume at this 20,000 level mark, which we've understood and we've seen, okay? We saw them also defending the 30K level and the psychological level at 40. And they've shown demand at these key levels, okay? Which makes a lot of sense. Now, this is a result of the transfer of ownership from capitulating sellers. This is really important, okay? So what happens is you've got two types of people. You've got the ones who bought in at 69,000 at the highs, and as they rode it down, they capitulate at different levels. They capitulate a little bit at 40, at 30 you get a bunch who capitulate, and then the kind of stronger ones still capitulate at 20,000, which is really painful for them and quite a sad thing. But what then happens in terms of forming a bottom, which is what we're trying to analyze here, is when they sell those coins, they're selling to more optimistic buyers, right? They're selling normally to long-term holders, and even the new short-term holders that they're selling to are far more optimistic. It's like, let's say you entered crypto in November at 69,000. You held it all the way down. You didn't sell at 40. You didn't sell at 30. Then you capitulate and sell at 20. But the person you sold to is somebody who's just new in the market today. They've just come in the market, say they see Bitcoin at 20. They're super excited. They get to buy at prices that 5 years ago in the bull run they could have bought at, and they're loving it, right? So they're more optimistic buyers ready for the next bull run to the upside, which is good because they will have a hodling dynamic for now because their cost basis is very low. That's what we're seeing right now, okay? That's really, really important. Now, moving on, the second thing I wanted to show you was this is when you entity adjust it. And what you notice here when you do that is elevated demand can similarly be noted around the 20K level, okay? So again, you're seeing that same 20K level showing that demand, and there's a declining maturity towards the market value, which is where we're at now, okay? That's really important. Now, this is the Maya multiple, which again, we've looked at many times here on this channel. This is the difference between your 200-day moving average and the current price, okay? So when you have a Maya multiple of 0.55, what that means is 45% off your 45% off your market price, okay? Sorry, from your moving average, which is really important. So what we've noticed, which is what I wanted to point out, is this orange section. These orange sections you're looking at here, these tend to market right at the bottom of the moves, right? If you look at the previous bear market, right at the bottom, you wicked below your Maya multiple less than 0.55, and then you went on your big run. Similarly with COVID, same thing, wicked below, just bounced below here, and then went, and now we're below it again. But you can see we're finally starting to cross back up, which is getting people excited that, okay, maybe we're just about here on this journey, right? Which is why we need to be in the market. So all generational bottoms have at one point touched the 0.55 Maya multiple level, and we've done that here on this bear market. Now looking at the MVRV. Remember, MVRV is your market value to realized value. It's the difference between the current market value, the market price, and a realized value, which is your aggregated cost basis, okay? So again, when this is below 1, what you see is this is where you see the max capitulation. So if you look again at previous bear markets, this has fallen below that level and it stayed there for a while. Again here in COVID, it fell below it and then quickly bounced back, and now we're below it again. But you can see we're getting this, if I just pop me out of the way, we're getting this bounce back up here, which is really, really important. You can see we've kind of got right to the bottom here, and now we're starting to pick back up here on our MVRV score, which is really important. Now, the other thing to notice is this leg down here in June time, where we wicked right to the bottom here, that actually created the record lowest 4-year rolling Z-score, which is what we're looking at here. This is the record low here on this indicator for the since the creation of this indicator, right? So this is crazy, which shows like there has been huge capitulation, and that is what's justifying why I'm thinking there could be that relief rally up to 28, 29, 30, just to relieve some of the stress. Now, by all means, what I'm not saying is I don't think this is suddenly going to go back up to the top, and that's the nuance I want everybody to understand. When I'm saying there could be a relief rally in the technical charts, when I'm showing you the charts and saying I think there could be a relief rally up to 28, 29, 30, I'm not personally giving the clearance that this is going to go back up to 69. That's not what I'm saying. I'm saying we could have a relief rally, just let out some of that pent up, which we're seeing here, and then we could still be here for a while. And that's the bit we need to understand, which is if you look at the previous cycle here and here, when you had your previous run up, you saw it, you felt your lowest levels there. But then you, at this point where my cursor is right there, you're still only a quarter into your lows, right? You were here for quite a while here before you ran up. So my question is, okay, we fell to the bottom. Maybe we get that relief rally like you saw here. And then you kind of just chill for a while, still quite suppressed in this lows before we then go for a run, right? Everybody thinks we're about here. Everybody thinks this is just going to happen now, which is going to suddenly run up. Like, I'm thinking we're more just about here. Maybe we could have a bit more sideways, but even then, I wouldn't be comfortable not being in the market right now, just in case this time is different, just in case we don't need to spend much time here this time, and we can start building our way back up. But most likely, in my opinion, is we'll see this kind of a pattern where we're here for a little bit of time. Moving over, we can then introduce the concept here. Again, shout out to Glassnode for sharing these amazing charts. Not sponsored, but just love the charts. Now, what we're talking about here is your coin days destroyed. Now, this is a bit of a complicated indicator, but I'm going to try to explain it to you guys as simply as possible so we all can follow it very clearly. When you have somebody holding a coin, they assign that a time-weighted value. Okay, now if you've held a coin for many years and then you've sold it, what this model is doing is saying that you've destroyed more coin days. Okay, so they're placing more value on a long-term holder selling than somebody short-term who's only held the Bitcoin for a couple of days and then sold. So in essence, when we're looking at this orange line here, we want to see, when does this spike? When this spikes, it means long-term holders, people who have held their coins for a long time, are deciding to sell. And again, if you look at previous bear markets, you notice that you get this huge capitulation event in between here before you get these moves up, okay? So you see that here, and you see that you saw a spike here, and we're seeing a bit of a spike here. Now, it's also important to notice you also get these spikes during bull runs as well, like there, and here. And the reason for that is long-term holders will sell into a bull run, right? They want to take profit, so they will destroy coin days during that period. But what we're looking for here is coin days spiking despite being at low prices, and that's what we're seeing up here. We saw that spike happen, and the question now is that going to continue? Because what we're seeing right now is long-term investors are selling, and they are selling at a loss, and the question is, how much longer are they going to be doing that for, and have we hit that final bottom? And then what we can do is we can combine the last two models which we've just looked at. We looked at the MVRV, okay, which is your blue, and then we've looked at the coin days destroyed, which is your orange. Let's superimpose both of those onto the same chart. And what we can do then is look at where they both occur at the same time. So we want to look for when MVRV is less than 1, okay, which shows that they're sitting on losses, and then we want to show where coin days destroyed are greater than the yearly average. Long-term holders are selling more than average, and when you combine the two, that they're selling and they're selling at a loss, they're selling a lot and they're selling at a loss, then we can say, okay, when those two merge at the same point, that is when you can find that capitulation is occurring. And that is what we're seeing right now in this region, is you're seeing the two occur at the same time. This shaded area shows exactly where the two are happening at the same time. And previously you saw that in the December 18, Jan 19 kind of period here during that bear market as well. Okay, so you saw that happen. You saw them happen at the same time. And then we finally were able to go on our move back to the upside. And is that what's occurring here at the same time? Keeping things moving, we can then take a look at the SOPR, spent output profit ratio. And what we want to look at here, there are two different periods to look at. So what I want you to see here is your blue line here is your long-term holder SOPR over the 365-day moving average. Then you have a 30-day moving average, which is this pinky red line here. Okay, now the shaded areas show this orange shaded area shows that the strong long-term holder profitability. So obviously in your bull run here, you're in huge profitability, right? Your monthly spent output profit ratio is greater than the average over the year, and things are looking good. But then in this period, your monthly is less than your yearly average. Okay, so you're now this is poor long-term holder profitability / loss during your decline. So we're seeing that exact same thing happen. But when you analyze how long these has taken, in the previous 2017-2018 bear run, that was 451 days. So we're about 60 or so days away from having about the same time frame. So we've been in this for quite a while when you look at it from this metric, which is quite interesting. So we have been in here for quite a while, and this happened from the summer of 2021. So a lot of people are saying, including myself, would sometimes look and say, well, technically the bear market started from November when we fell from 69, which is right. But the on-chain metrics are saying that the markets have been suffering from a lot longer than that. They've been suffering from the summer of 2021, which makes complete sense because that is when these two flipped. And then we saw that short-term holders started seeing losses from that period. Okay, very, very important that we understand that. So this is giving you a clue that, look, we're at the bottom, right? However you want to look at it, we are closer to the bottom than we are the top. Now, whether we're going to wick down to 17,600, 18,000 one more time, 19,000 one more time, to be honest, frankly, it's irrelevant. And also, it doesn't matter. Everybody will have a different opinion. I've got my opinion that I've got this weird hunch, just based on looking at some data and my feeling that maybe we can wick back down. But I'm not going to go on that hunch, right? I'm going to make sure I'm in the market. And I've continued to be in the market. I held all the way from the tops down. I continued to dollar cost average in. I'm still dollar cost averaging in. I still understand the risks of the market. But when you calculate all those, I still want to be in the market. And that's what we're seeing right now. Okay, couple more just to show you guys. I told you this is going to be an in-depth one, so thank you for staying tuned and thank you for smashing up the like button whilst we're going through what can be quite a complicated topic. And I don't like it when certain YouTubers and influencers try to trivialize this stuff to make it seem like it's so easy. They do that for the views, they do that for the clout, and the reality is this stuff is very complicated, and people just giving you sweeping statements of we're running to the top and down. They just want to be a perma bull and then a perma bear all at the same time so they can win either way. Now that we've looked at capitulation, I think we agreed that we are hitting all the metrics that sign off that capitulation has happened. We've seen the profile of the distribution of holders change. We've seen us on the market value to realized value. We saw coin days destroyed. We've seen all of these kind of models merging. Now we need to say, okay, this swing rally, we can justify, right? The technicals I showed you, we can technically run from 24 here up to 30K and see that kind of a move. That's perfectly fine, and it's normal. But where are those resistance levels going to come from? And that's where we can look at a few different models. Now, the first one I want to show you is the blue line. And the blue line is something we've covered off many times here on this channel, which is our 200-week moving average. You guys remember that's always acted as long-term support here for Bitcoin, but we lost it. We broke below it recently, and now we've seen that this 200-week moving average is sitting at 22,000. So we've broken back above it now, and with us being at 24,000 at the time recording this video, we've managed to get back above it, which is really good. So that's the first overhead thing that could have acted as resistance. Now the next one is the purple one, which is your 111 daily moving average, and that's one of the components of the pi cycle, and that's sitting at 20K. Okay, that's sitting at 20. I think it's sitting at I can't remember the exact number that's sitting at. That's 20K. I'll have to confirm. I'll put it on the screen here where this moving average is sitting. What is the value of that? So that's our next resistance, is when we start working towards that level. And it looks to me like from this chart, it's probably at about that 30K level. I think that's 30K level. Then we've got the next level of resistance, which is your 200-day moving average. Okay, this is really important, and this will be your proper breaking point. This is where you really start to crush some of those bears and flip your weekly EMA ribbon as well, which is something we look at, bullish again, and then we can get excited that we've really capitulated the bears and we flipped the long-term trend back bullish, and that is sitting at about 35K. So in essence, what we're saying here is there's a bunch of upside resistance, right, pressuring us from the top side, overhead resistance pressuring us from the top side, including the ones we've just got above, which is a 200-week moving average. We've then got a bunch of others ahead, which signify that, okay, maybe this is just a swing rally. We can't get excited that we're going to get above 30 and 35K yet, but that is our next aspiration once we get there, and that's what we'll be looking at keenly to see whether we can break some of those levels. Okay, then moving on, we can then look at the on-chain metrics as well in terms of looking at the short-term cost basis. And what you can see here is the short-term cost basis continues to fall. So in essence, what we're seeing here is that is now sitting at 28.5K here, the purple line here, for the short-term holders. That's their current cost basis, which is interesting. So that's starting to decline now, which is a good thing. And again, this is what I was showing you before, that short-term holders are capitulating and moving across. The distribution is moving across to new short-term holders who are more optimistic, right? And that's bringing the cost basis lower, which is good. We can start getting more hodler mentality instead of selling mentality, right? If you've got someone who just held from 69,000 and has just sold now at around 20-something to a new holder who's just bought in at 20-something, right, they're going to have a far better hodling mentality ready for the next run, because they're buying in at 20 hoping for all-time highs, right? So they're going to sit on their hands. If it falls to 18,000 again, they're not going to suddenly sell. That is one of the indicators that, look, this bottom is really getting formed right now, and it's really important to see that. And then finally, let's take a look at what was the last one I wanted to show you guys. I think that was the last one. Okay, so that was it. So I do want to show you here on the technical charts again, just to tie that back in with what we've just seen. I do pop me back over there. So coming back to what we see, what do we see? We saw those on-chain metrics show us that there is some resistance at 30,000, right? From the pi cycle indicator. So you can see that coming in here, which is exactly what I'm saying. That's where I'm saying the relief rally could be, right? From this 20 level up to about 29.30, and then we're going to face a bit of resistance. And the question then is, do the bears show strength to push us back down, or will we see a move up through the levels, back up for our next resistance level, which was at 35? Remember, 35 was the 200-day moving average I just showed you. And that is exactly where the top of the EMA ribbon is. And that's exactly where I would say is if we broke 35,000, 36,000 here at the top of your EMA ribbon, things turn super bullish then. Then you've really rotated the strength away from the bears back into the controls of the bulls, and things are looking exciting from that point. So for now, all I'm saying is this bit is a relief rally, okay? The second bit, once you flip above your EMA ribbon, that's the hard bit to do. And when we do that, things are really going to get exciting for a next return to all-time highs and breaking those all-time highs. But let's keep in track. Where are we at right now? What is the market saying? As you can see, when you take a quick look at the fear and greed index as well, is you're seeing that at highs is sitting at 39. The market is feeling euphoric after yesterday. 3 days of a rally, a really positive week last week as well on Bitcoin. The market is feeling positive, right? 2 weeks in a row now looking like of green, and the market's feeling positive. You can see how quickly things can move. So if you haven't watched my video on why you need to be in the market, or if it was me, why I would be in the market, go and click here, smash up the like button and subscribe. Don't forget to check out BYBIT and BitGet, links in the description, and I'll see you in the next one.